Hi guys, thanks for tuning in to another episode of Nuggets News. Today I want to talk about algorithms, bots, and high frequency trading, how it's entering the world of cryptocurrency and how it affects the stock markets, why I believe this is a big risk to the stock market. We're going to go over some of the definitions, how this is meant to help the market, but why I believe it's going to hinder the market, and have a look at how this works in the real world with exchanges, different strategies, and so on. So I hope you guys enjoy this one, but let's go over a few of the definitions. So an algorithm is just any piece of software, math that someone writes to automatically execute trades, buy and sell at given points, as opposed to you or I that maybe use technical analysis to set our buys and sells, or just click buy or sell when we sign into an exchange and we see the price that we like. So these algorithms can be programmed to all sorts of things these days. We think of some basic strategies such as, maybe we'll tell the bot to sell when the RSI, one of our technical indicators, gets up here overbought. I've done videos on the RSI. Other people might like to use the Bollinger Bands or moving averages, and they build these bots to say, sell when it goes outside the Bollinger Band, buy when it goes back beneath the Bollinger Band. And that's just a basic bit of math, and they'll program a bot, a computer, to execute that algorithm and just do that for them. And there's lots of scams out there. I should say that first before you go searching Google's bots and algorithms, and they're all going to promise you to make 1% a day. So 99% of those are scams. To be honest, I've had a lot of people come to me over the years and tell me that they've had a bot that works great. And when I ask them that, does it work in up markets, down markets, volatile markets, they rarely come back to me a few months later and say it's still working. So just be really careful out there if you're going to try and use a bot, sign up for anything. But in the world of finance and the stock market, there's plenty of these that are done professionally by the big hedge fund firms, and they won't tell you their secret sauce, how it all works, and they're using this to their advantage. Now, high frequency trading is a new concept in the modern stock market, now that it's all done by computers and algorithms and bots, and they can trade up to 1 billion times a second. And these are just computers that are going back, buying and selling off each other. And this is meant to have supposed benefits for the market. So what are they? How does this work in the stock world, and how is it creeping into crypto? Well, what it's meant to do is add liquidity, volume, and help reduce volatility. So what we see here is a classic order book. So this is the layout on Binance where we have the bids. These are people that are all waiting to buy. They've put in a bid. This is the current price, the last trade executed at, and these are the asks. So these are sellers that have set their price in the order book. And what we generally find is, the further away you go from price, the more people are there waiting to buy if it dips lower, and more people waiting to sell up here if price goes higher. And then we have, less liquidity right at the current price, particularly if we break it down to the 2 decimal points. Now, in the stock market world and Forex, we can even go beyond 2 decimal points, which we're not really used to in the crypto world. But what the argument is that by having these bots that are trading back and forth, each of them are implementing different strategies that we just spoke about. Some of them are just trading back and forward for the sake of it. And we see this in the crypto world because they claim that it adds volume. So this looks really good on CoinMarketCap. All this volume's being traded on this coin. It's really popular. That's one of the things that happens a lot in the crypto market. So by having those bots trading back and forth, the argument is that it actually, increases liquidity here, adding more people that would be buying than otherwise would, and adding more orders, people that are selling that otherwise would. So it's generally good. And what happens if we have a volatile market? If the market moves down, well, then there's more buyers there and it cushions that fall. So it reduces volatility. So this is the same in the stock world and the crypto world, but you guys know that the majority of volume that happens in the crypto world is very fake, and often it'll look like there's a lot of liquidity. You'll go to buy or sell, and then that order will be pulled away, and that's the next thing that I want to talk about. So in the crypto markets, let's say that I'm signed in and I can see that someone is looking to sell a Bitcoin for $10,000 and 0 cents. So then I actually click buy at that price, and it might say that there's 2 Bitcoin for sale. So I try to buy 2 Bitcoin. But then when the order goes to those servers in the warehouse of the exchange and gets into the system, it doesn't execute. So I'm sure plenty of you have noticed this, or you get a far worse price than what you were quoted. And what it can be happening a lot of the time is that there are bots and algorithms that are just putting up these fake bids and offers and asks. And they pull that away when they actually see an order come in. It's not real volume, it's not real liquidity. So it's not really helping volatility there either. But I want to dive into how it works in the stock market world, because that goes a level further again. And this is probably creeping into the crypto world before we even know it. So this is our example here with one trading firm, one company down here. Again, they might have to route to a server and then to the actual exchange with their order to buy stocks or Bitcoin. And then someone else, a trader that's sitting at home, again, they might live closer to the exchange and they route their order. So what began to happen, this was in the early 2000s, there's a guy called Brad Kutsuyama, and I recommend you watch his talks about this. He was working for a trading firm and he noticed that every time he went to buy some shares and there was a current ask there was enough volume that he wanted, he clicked on buy and the order was beginning to get filled less and less, and this got worse over a couple of years to the point where almost none of his order would get filled. And to begin with, all of that order used to get filled. So why are the orders being taken away, or why is someone else beating him to it? And what he found was that these exchanges had built bots and algorithms and high frequency trading to front run his order. So what that means is that when he's sitting here at home or at his work and he executes that order and sends it to the exchange, there was another company that had a closer connection and they could see these orders come in. So they could see that he wanted to buy it for 10,000. So they would execute their order and buy that off him. And particularly if he's just hit buy at any price, all of a sudden they're buying that and then they move the price up and they sell it back to him at the higher price, and they make that difference straight away. So it is basically cheating, front running. You know what orders are coming in, and because they had a physical closer connection, they're breaking this down to millionths of a second, they can actually beat his order in. So this is where the story gets really interesting. He noticed this happening and first of all, he couldn't work out what it was. Once he'd figured this out, they tried different things like using a wireless internet that had a better strength to get to the exchange faster, rather than the internet. And the physical distance between these two companies to the exchange made such a huge difference, and everyone else, all the other exchanges, caught wind of this. So there were even examples of computers that were going to the most direct server, to the point of, hey, I'm connected to this one, you're connected to this one's actually physically closer by a few meters even to the exchange. And so all of a sudden everyone said, hey, I want to be hooked up to this server here that's closer because it's shaving off 3 millionths of a second, and that way my bots, algorithms and high frequency trading are going to work better because we can see what's happening before you can. So this got really heated, and in one of the interviews and talks he does, he talks about how Toys R Us, a kid's toy company, actually had one of the best servers in this building, and a lot of people were trying to beg them to let them use their server because it was physically closer to the actual exchange to get executed and be able to front run all these trades. So really fascinating stuff. It actually got to the point where these people were sick of being front run. So what they did was actually bring a physical cable and actually use this wound up, a kilometer of cable in between these two servers to prevent the server actually, relaying and these people being able to see what they were getting. So they physically lengthened the cable to add, more millionths of a second before it could relay and tell the other computers what they were seeing. It then got to the point where these guys were arguing about who had the straightest line of cable, again, to the main server. So really, really crazy stuff, getting down to the billionth of a second in the end for whoever had the best algorithm to cheat the others and front run these orders. But this is where it gets dangerous and what I believe can be a downfall in markets. So recently we saw some flash crashes. A few years ago this happened in the stock market world. We've seen it with the volatility index recently. And because a lot of trading in the stock world is done on margin, it's similar to margin trading in crypto. We see these huge swings. But when all these bots have been programmed to go back and forward, and over time in stock market land, we've had a pretty nice bull market for basically 10 years since the GFC, since this has really become the dominant form of trading. Some estimates between 70 and 90% of all trading that's done now is done through algorithms and computers. Gone are the days of the guy that's doing some fundamental research and looking for value investing. That sort of thing is just becoming less and less now in the world of computers and these indexes. So what happens now is, if these people, these bots, haven't been programmed and never seen a bear market or these volatile days, all of a sudden they stop working, or we don't know how they work. And that's what happened a few years ago, when all of a sudden all the orders, they just get pulled. They hit their limit or their circuit breaker, and they pull it. And all of a sudden we don't have any volume, any liquidity there, and these markets just absolutely tank. So they're actually more dangerous than previously, because there's the illusion of good volume and trading when there's none. And more so, these algorithms may panic and further force markets down than they would have gone down naturally. Why are markets trading these billions of orders, and the actual real volume that is there is being cheated by these people that are trying to sell it back so they can make someone else buy it off them again at a higher price. So it's actually doing the opposite and making markets more volatile. So there's some, again, great pieces out there. I recommend you watch that if you want further information about that. Let me know if you've tried using a bot or a strategy in the crypto world or in the stock market world, and do you find this subject interesting? So I hope you guys have enjoyed that, something a little bit different today. Smash that like button, subscribe if you haven't already, share these videos around, and thanks for tuning in, guys. Cheers.